As a retiree, it's crucial to not only protect your capital, but also ensure a steady stream of income to meet your living expenses. But selling shares during a market downturn can be tough, both financially and mentally. The solution? Diversify your portfolio with high dividend exchange traded funds, or ETFs. These ETFs can replace or supplement your traditional equity allocation and provide a reliable source of income. Today we'll go over the top 7 picks for best dividend ETFs for retirement investors. Don't let market fluctuations ruin your golden years, and secure your future with these smart investment options. Also, these investments aren't just for retirees, and they're not your plain old buy and hold the dividend strategies either. Some of these funds use option strategies that make money when the market is not moving anywhere or even moving down. Plus, the number one name on our list has a dividend yield of over 14%. You're going to want to stick around for that. To keep updated, be sure to subscribe and hit the notification bell so you can be amongst the first to know when more investment inspiration videos are available. First on our list, Vanguard High Dividend Yield ETF, ticker symbol VYM. Now this is a popular dividend ETF amongst investors. Vanguard High Dividend Yield ETF tracks the FTSE High Dividend Yield Index, which holds a diversified portfolio of 442 top US large cap stocks with above average forecasted dividend yields. In other words, this ETF looks to the future rather than the past when making its investment decisions. VYM falls into the large cap value category with a focus on sectors such as energy, healthcare, and consumer staples. Just take a look at the top holdings. They include industry giants like ExxonMobil, Chevron, Procter & Gamble, and Johnson & Johnson. The best part? VYM charges a very low expense ratio of just 0.06% and offers a 30-day SEC yield of 3%. Now don't miss out on this reliable and cost-effective investment option for your retirement portfolio. When it comes to selecting dividend ETFs, there's more than one way to go about it. While some ETFs, like the Vanguard High Dividend Yield ETF that we just covered, focuses on high yields, others, like the Schwab US Dividend Equity ETF, ticker symbol SCHD, has a different approach. SCHD tracks the Dow Jones US Dividend 100 Index and holds a portfolio of 103 US stocks with strong fundamentals and a history of consistent dividend payments. With top holdings such as Verizon, Broadcom, Merck, Pfizer, and Home Depot, this ETF has proven to be robust and resilient. In 2022, despite the market turndown, with distributions reinvested, it only lost 3.3%. And just like the Vanguard High Dividend Yield ETF, it offers a 30-day SEC yield of 3.3% and charges a low expense ratio of just 0.06%. So if you're looking for a different approach to selecting a dividend ETF, do take a look at Schwab US Dividend Equity ETF. The next ETF on our list offers an extra layer of defense to your dividend ETF portfolio by implementing a low volatility screen. Invesco S&P 500 High Div Low Vol ETF, ticker symbol SPHD, focuses on stocks that have a lower than average standard deviation and beta, providing a more stable investment option. Basically, it looks for stocks that move less violently than the S&P 500. This ETF is composed mostly of defensive stocks from sectors such as consumer staples, utilities, and healthcare. Notable holdings include Kinder Morgan, Altria Group, Gilead Sciences, and others. SPHD offers an expense ratio of 0.3% and a 30-day SEC yield of 4.3%. Add this ETF to your portfolio for an added level of stability and protection for your retirement investments. Next on our list, an international ETF. Retirees often focus on US dividend stocks for their tax efficiency, but international dividend stocks should not be overlooked. That is what this next ETF on our list focuses on. iShares International Select Dividend ETF, ticker symbol IDV. Now, international stocks can offer high yields without taking on significant additional risk. Plus, holding on to international stocks can hedge against the possibility of the US market stagnation, as it did between the years 2000 and 2009. A great way to gain exposure to high quality dividend stocks from developed markets like Canada, the UK, France, Japan, and Australia is through this ETF. Now, the IDV ETF tracks the Dow Jones EPAC Select Dividend Index, which holds a diverse portfolio of 102 international dividend stocks, such as British American Tobacco, Canadian Utilities, and the Bank of Nova Scotia. IDV currently offers a 30-day SEC yield of 7.1% and has a low expense ratio of just 0.49%. Diversify your portfolio and consider adding IDV to gain exposure to international dividend stocks. If you like these types of videos, be sure to give us a like, subscribe, and hit that notification bell so you don't miss a new investment inspiration video as soon as it's available. The next ETFs on our list deploy an additional layer of strategies to generate income or protect against market downturns. These strategies would require a little more research and understanding of financial market derivatives to implement ourselves. These funds, though, make this type of strategy accessible to anyone. In 2022, the balanced portfolio of stocks and bonds suffered nearly as much as a 100% stock allocated portfolio. This was a result of the stock market entering a bear market as interest rates rose steadily. This forced some retirees to consider other strategies for portfolio protection. An alternative to bonds is an options caller active ETF like the nationwide NASDAQ 100 Risk Managed ETF, ticker symbol NUSI. This ETF aims to provide high monthly income and downside protection. The ETF begins by selling an out-of-the-money NASDAQ 100 call option for cash premium. NUSI then uses a portion of this premium to purchase an out-of-the-money NASDAQ put option, which provides crash protection. The remaining premium is paid out as monthly income. The ETF also owns the names in the NASDAQ to complete this option caller strategy. The NUSI performed well during the March 2020 COVID-19 crash thanks to this options caller strategy. The ETF has an expense ratio of 0.68% and a 12-month trailing yield of 10%. This can be a great addition to a retiree's portfolio looking for a diversified way to both generate income and hedge against any market downturn. The next ETF on our list has gotten a lot of coverage here on YouTube. It's the JPMorgan Equity Premium Income ETF, ticker symbol JEPI. Another actively managed ETF, JEPI combines stock selection and an options overlay for enhanced income. Now, the fund managers start by conducting a bottom-up fundamental analysis to select stocks which currently include names such as AbbVie, ExxonMobil, Coca-Cola, and MasterCard. Then, the ETF sells out-of-the-money call options on the S&P 500 to generate monthly income. The ETF proved to be resilient during 2022, losing just 4.5% with distributions reinvested, while the S&P fell by 19.4%. This ETF has a low expense ratio of 0.35%. JP Equity Premium Income ETF also offers a 30-day SEC yield of 11.8%. This ETF is a great option for investors who are willing to consider actively managed strategies that can provide a higher yield at the same time and be more resilient during market downturns. This strategy also utilizes the S&P 500 instead of the NASDAQ like our previous ETF. Last on our list and paying out 14.4%, Global X NASDAQ 100 Covered Call ETF, ticker symbol QYLD. Option strategies can be a powerful tool for transforming the risk-return profile of an investment. This is the one ETF that utilizes this approach very well. QYLD sells an at-the-money covered call option to turn this tech-heavy, low-dividend NASDAQ 100 index into an income powerhouse. By selling covered calls, QYLD converts the NASDAQ 100 potential upside into immediate income. While it may lag during a bull market, QYLD has the potential to outperform in a sideways market and even cushion losses during a bear market. The ETF has consistently made distributions monthly for 8 years. Now, thanks to the high volatility of the NASDAQ 100, QYLD's option premiums run high. It currently offers a 12-month trailing yield of that 14.4%, and it has an expense ratio of 0.6%. QYLD is a great example of how option strategies can be used to create a unique return risk profile for an investment. Did you know that there were these types of advanced strategies in the last 3 ETFs that were available for you to add to your portfolio? Let us know in the comments below if you have ever invested in any of these types of ETFs. For more top lists of investment inspiration, be sure to check out our playlist of the top paying dividend stocks, and we'll see you there.